Welcome to Rockin' My Business. I'm Sherry Simoes, and I've been coaching entrepreneurs for over 25 years to create a successful business.
And I'm Jana Benedict, also coaching entrepreneurs for over 25 years. So Sherry and I have over 50 years looking after new people and not so new people in business.
I am so excited about these short little chats with entrepreneurs around the globe and local entrepreneurs, just to talk about different discussions of interest. And today we have on the show with us Sharon Abrego from Mortgage Alliance, and we are going to talk about rocking your credit score.
Hi,
Welcome,
everyone.
Sharon.
Thank you. So like you said, we will touch a little bit on credit score and what it means and how it affects your lending rate. So first things first is, how do you find your credit score? You can go to Equifax.com and pull your credit score there. There also is a credit score checker on my website at kwdreammortgage.ca that will lead you to a link where you can check your credit score. The number one thing I find is to know what your credit score is, because if you don't know what it is and what's affecting it or making it low, or if it's in good standing, you won't know how to fix it or how to get from point A to point B in order to qualify for a mortgage. One of the things is the scale of mortgage or credit scores. So a low credit score would be in and around 400 or 500. A high credit score is 900. So 900 is like pristine, never was overextended, never missed a payment, etc.
Okay.
What the lenders will do is they will try to, they'll look at the overall picture. So they'll want to see, so first off, what your credit score is. They'll want to see what kind of credit cards you have, and that you're able to stay within the limits. Ideally, they'd like to see that you can stay 50% of your limit and below, to show that you're responsible and that you can manage your money well, and that you're not overextending yourself with too much debt. Another thing that they will look at is late payments. So as I touched base on this a couple of shows ago, was even a small thing such as a cell phone bill. That will affect your credit score if it's not paid on time. There are time and time again that we see people trying to get pre-approved, and they've got 3 or 4 months consecutively where they've missed payments, and that's brought their credit score down drastically, and it's hard to get it back up there once it's down. Another thing would be your work history. So that does show up on a credit report. It'll show where you've worked in the last couple of years. So in general, when applying for a mortgage, you'll want to have at least 2 years of work history. That way they can see that you're a steady person, and that you are committed to that company, and that there's some stability there.
What about self-employed individuals? How do they look at that?
Self-employed individuals, it's the same. Like, they still would like 2 years T1 general, so to show that you've had an income. Now, I understand with being self-employed, you have write-offs, and ideally you'd want to work with a good accountant who can help set you up in such a way that it is in your favor for a mortgage approval down the road. They will know exactly what that means. You'll want to be careful of what your expenditures are, and what you're writing off is not too high, and that it's reducing your income in the end.
Right. So do they look at net or gross income?
They'll look at net income. Yeah.
Okay.
Another thing is for people who have bruised credit. Typically, if it's a bankruptcy or a consumer proposal, we'll want to see that cleared off, like paid off and cleared off of the credit bureau for at least 2 years before they can be considered for a mortgage. There are some lenders who may look at it but then that's when you get into the much higher interest rates, because you're going to private money, and that costs more to do. So that's just a little note on bankruptcies and your credit. Ultimately, if you can make your payments on time, if you can stay within your limits for your credit cards, and make sure that your credit score is where it needs to be, a mortgage agent can help you make sure that once you're ready to apply for a pre-approval, that your credit score is where it needs to be, and they can work with you on that.
Great. So what if someone has poor credit? Do you have some tips on how someone could boost their credit quicker than slower?
Absolutely. Small things like making your minimum payments, making them on time, and making more frequent payments throughout the month. So not just your one typical payment on your credit card. Even if it's a $10 payment halfway through the month, another one a week later, as long as you can make small but frequent payments, that really helps drive your credit score up. Because it's kind of showing the lenders and showing the credit bureau that, whatever extra money you're getting, you're putting towards your credit score, and making sure that, you're able to bring that up and be responsible for that. So that's definitely a thing to keep in mind.
That's a good tip.
So if someone did go bankrupt, say, and they were starting fresh, I know that I read somewhere that someone should get a new credit card and try and use it frequently. Use it, pay it off, use it, pay it off, use it, pay it off. So that would fall into that, I guess,
Yes.
category of what you were describing.
Yeah, absolutely. So what they could do, there's a couple of choices out there. So you can get like a prepaid Visa card where you put money ahead of time, and then for every purchase that you're doing, it's essentially just taking off of the money that you've already got placed on the card, and then you just pay that money back. So that builds credit. And they may be able to say, for your local businesses, go in and apply for a credit card for like $500, let's say, or like a minimal amount, and then that way you can kind of build credit that way, say with a Walmart card or something like that, where you would just apply for a small amount and pay it off every month, and make sure that you're making your payments on time.
Mm-hmm. Good advice.
Yeah, that makes perfect sense to do that. I was talking to somebody the other day, and they said that they had gotten a new card, but they were just going to put it away. Like it was, I guess, not a replacement card, but like a new one with a new date on it. But they hadn't used their old one, and they weren't even going to activate this. And I said, that's not going to really help you build your credit, because you don't activate and don't use it. I'm correct in thinking that, right?
That's right, because on the credit bureau, it shows your minimum and your maximum. So what was the lowest that you had the card at? What was the highest that you had the card at? And if you're not using it, there's going to be nothing for them to tick off that you made payments on time or anything like that. So it's absolutely bringing zero value to your credit score, and trying to improve it. It won't do any good.
Okay.
I was helping a friend who asked me for a little bit of advice, and I did make sure I told her that I was not an expert, but I told her to, because she was missing payments all the time and forgetting. So I told her to set up for the automatic payments, so that she never missed a payment. So that might be one thing people can also do, is to make sure they're enrolled, because it is easy to forget. All of a sudden it's the second of the month and you're supposed to pay by the first. Well, there's another late payment, right?
Yeah. And that's the thing too, is that people will say, well, I was only a couple of days late. In the finance world, 1 day late is just as good as 30 days late. So even if you're 1 day late, you're still going to be marked that you were 30 days, because you were within the 30 days of being late. So you want to kind of, with the there's like a tracking system of how they go about that. So like R1 would mean that, you're in good standings. And then the more the number beside the R goes up, that's how many more months you've missed. So, you know, if you have like well, R9 is the worst. That's when you've, you know, you're in consumer proposal or you've declared bankruptcy or something like that. That's the worst rating you could have. But yeah, it all plays a role in the credit score for sure.
Right.
One question I have is, if you have, for example, and I know this to be something with one of my children, or grandchildren, I should say. If they have a credit card and because of what's happening, they're not working and they're struggling a little bit, and they're not making the minimum payment, but they are making a payment every month, does that help?
I would say no, only because the amount that's set is what the creditor is expecting you to pay back. So right. In essence, they signed a contract when they got the card that they would fulfill their requirement of making
a minimum payment.
Right. So if that's not being met, I mean, it might be a good idea for them to call that credit card company and see if they can get that amount reduced. We're seeing even lenders that are helping families out right now with not having to make their mortgage payments through the mortgage deferral. And they're promising not to go on to the credit bureau as a missed payment. So there are ways around it. It's really to be transparent with the one who's lending you the money and kind of explain the situation and see if that might help better. Because you don't want to really make a payment and it's not enough and it's still, you're in the same boat as you were before, not being able to make that payment. So it's best just to call them and see if you can get that minimum amount down, and, you know, just for the next couple of months until things improve.
Okay, that's good to know. You know, it's good advice. Thank you.
No problem.
Very good. Do you have anything else that you want to discuss today, Sharon?
I think that was, oh yes, one really big point is in terms of loans. So let's say you want to be pre-qualified for a mortgage, but you really need a new car, or you really want a speedboat. Whatever floats your boat, but you want one really bad, and you're like, you know what, I want a house, but I really want that boat. Word of advice is try not to buy anything of a significant amount a year before trying to apply for a mortgage. It is amazing how much, say on a brand new truck, you know, $800 payment a month, that is going to eat away at your income amount that's supporting your ratios for mortgage pre-approval big time. And people don't realize that. They think, well, it's a payment, it's a necessity, yes, but you can also have another vehicle that isn't $800 a month that will still bring you from point A to point B. It just all depends on what you want more, but it's going to affect the credit score, and it's going to affect the mortgage application process and getting pre-approved, because the lenders will say, well, if you have that much money going towards that, and now your ratios are really tight where there's not a whole lot of money left at the end of the month, they're going to kind of question that, and it may not work in your favor.
Right.
Makes sense.
That's good advice for people who are looking ahead. They might have to sacrifice.
Yep.
A worldly
the name of the game. That's right.
All right. No yachts. Oh dear.
No speedboats.
Yeah, I know, right? Can't travel around the world this year. I guess I'll have to do it another time, you know?
What about a big purchase that you're not making payments on? That's different, right? You're talking just about payments, something that you finance, right?
Yeah, so let's say if you have savings elsewhere and you're spending it on something, that's up to you. There is a section on the pre-approval link or the application that wants you to list all of your debts and your assets. So if you have money that you're saving, It will help if you're, depends on if you're wanting to use that money as a down payment, then it wouldn't be wise to go spend it on, say, a trip or whatever, something that you're not making regular payments on, but that you're, a lump sum payment for flights or whatever. But it doesn't have an impact the way a regular amortized loan would have in the overall picture.
Great. Well, Sharon, thank you so much. Janet, it's your turn to ask Sharon the question.
To ask the question. Okay, I think we asked you this question on our last show, and it's like, what is it about you that rocks your business?
What is it about me? I would say having knowledge in the field that I'm in and understanding each of the lenders that I can bring to the table to best suit everyone's or your specific situation sets me apart from anyone else, because even the banks, they can only sell their one product of mortgage products that they have, but I have access to multiple lenders and I'm able to bring that to the table, which benefits you in the end, because we can then try for a lower mortgage rate, which puts money in your pocket. Which
is wonderful.
We all like that.
Yeah, absolutely. Nothing wrong with that at all.
One step closer to that yacht or that travel.
That's right. Well, thanks again, Sharon, for doing another show with us. We really have enjoyed having you here.
It's been a pleasure.
And look forward to hearing from you again as things change in the mortgage world. I'm sure we'll want to hear some updates along the road as well. So
absolutely.
Yeah. So from Sharon and from Sherry and myself, that's it for this episode. So take good care and go rock your business.
Yes.
Rock on.
And I'll end by saying, if you would like to be a guest on this show, you've got something good to say and share with our listeners, please reach out to Janet or I and apply to be a speaker. Thanks so much.
Bye now.